Hi, everyone. Thanks for joining today's webinar. My name is Dave Mantell. I'm a certified financial planner and partner with Stabler Wealth Management. And for today's webinar series, we will be covering a topic which is at the top of everyone's mind. How much do I need to retire? This presentation today is focused on Boeing professionals that are especially within 3 years of retirement, which is really where the rubber hits the road, and we need to make sure we're getting retirement ready and setting up a good path for that. And therefore, for anyone who's not within 3 years, still please join us today. We'll cover some really important content, but especially those within those 3 years of retirement is really who this presentation is going to be focused on. All right, well, let me share my screen here and we will go ahead and get started. So as noted, for today's webinar, we will cover the $1 million question on everyone's mind, or in some cases, $2 or $3 million question, right? How much money do I need to retire from Boeing? And in addition to answering that question, we are also going to cover a lot of key nuances in terms of how to achieve a secure retirement along the way. So for today's webinar, we're going to break it up into 3 main components. The first piece, we're going to work backwards and answer that question, what does your dream retirement look like? And then how do we work backwards from there in terms of securing it and what you need? The second bullet, which is a very important one, is reviewing your income streams and that gross versus net of tax equation. Because remember, it's not how much money shows up on your 401k statement or what your salary is. It's what's actually hitting the bank account, what's spendable. That's the key to driving a secure retirement. And then for the last section, we're going to bring it all together and cover how to calculate that retirement number in terms of how much you need to retire. And so remember, it's important to note that this is a roadmap and it only works if you stay on course along the way. And so we'll hit on this throughout the presentation, some of those key guardrails to manage to assure that we don't only have a good retirement plan, but we have the tools to adhere to it. And throughout this presentation, if you have any questions, please email us at info@stablerwm.com, and we'll look to get those responded to and answered. And likewise, we could always connect with you outside of this webinar presentation as well to answer those and dive in a bit deeper where helpful. So before we jump into the meat of the presentation, just a couple words about us. So at Stabler Wealth Management, we're a team of certified financial planners. We specialize in working with Boeing employees and helping them, prepare for, transition, and succeed in retirement. And and we're really just dialed in on having personalized service, personalized care to drive better outcomes for our clients. And so this webinar, as well as other, content, articles, communications, we'll make sure to upload to our website. So you could get right to the Boeing page by going to www.planyourboeingretirement.com. And likewise, feel free to pass this on to other people, because as we have important content down the road, we will make sure to post this in a timely manner on the website. Okay, so jumping in, as I noticed, step 1 of coming up with your retirement number is working backwards and looking at that end goal of what is a dream retirement to you. And so when we think about retirement goals, there's a few different buckets to think about, right? One of which, and really the baseline, is we need to maintain your lifestyle in retirement. So we have this set up as a base of the pyramid here, where you want to be comfortable, continue to do what you want to do, not worry about covering your, essential expenses. The second layer of this pyramid here is, what additional purchases do you have coming up? Do you want to do additional travel during retirement? And, just really making sure you're enjoying your time in those retirement years, especially early on when you're more active, and you're able to identify what you want to do and make sure you have a path to do it. And then the top of the pyramid, which in many cases, can be the, bottom layer and the foundation is, do you have a need or a goal to help family or pass wealth to others or have charitable endeavors? And so again, those are other goals we want to make sure we have the means to accomplish before you take in that big plunge into retirement. And so in determining what that retirement income need is, again, we like to break it into those buckets. So what are your essential spending needs? Excuse me. The additional discretionary needs, and then the budget for the one-offs. So when we work with clients, we always start with cash flow planning, and this is critical. Excuse me, got a little frog in my throat. This is critical to follow the cash with your financial plan. Cash is king, right? And therefore, by filling up these three buckets and drafting up a plan, we can make sure to build out a secure retirement strategy before you launch in. And so, as you can see in this upcoming chart here, for example, someone may say, hey, I have $5,000 a month I need on my essential spending, paying for groceries, keeping the lights on, paying for gas. You might say, hey, I want to budget another $3,000 for discretionary spending, including travel, eating out, entertainment. And then what are those one-offs, right? Do we need to come up with a budget for house projects? Do you have a new car coming up down the road? How often do you purchase new cars? And so when you tally all that up, we could come up with a monthly target budget and then an annual. And now remember, with clients, we've especially seen this take hold recently where inflation has really creeped up, right? And this can absolutely put a wrench in anyone's picture if you're not budgeting appropriately for those inflation increases. And so whenever we're working with clients, we need to assure that we have an inflation plan to handle how your expenses will go up with inflation, and how certain areas especially can really be subject to that, and making sure our portfolio, is strong and able to kind of match that given these, risks that are potentially out there. So once we figure out, okay, what is our spend in retirement? What's our spend going to be over time? Next, we got to look at your net income streams and how we're going to come up and cover those expenses. So, as you can see on this slide, there's sort of three main categories when it comes to retirement income. In this case, at above the line, maybe we should have flipped the visual, but the above the line here is what is that floor income? And so this is Social Security, this is pension, but basically what's coming in like clockwork month in, month out. And that's could be the base of your income plan and cover, a sizable portion of your expenses. But below the line here, right, is your investments in your lump sum. And so this is meant to bridge and cover the remaining expense need, which is not covered by, Social Security and the pension. And, so this is why we're putting all that money into the 401k, right? And, not enjoying that hitting the bank now, but instead putting it in savings for later is, this is where that money is going to return the favor and can be used, as kind of another tool to cover your expenses throughout retirement in your lifetime. And so, something important to note there is I include investments in lump sum because lump sum is the same category, right? If you choose the lump sum with your pension decision, rather than getting a monthly income benefit, you instead are getting a big chunk of money that can be tax deferred and go into an IRA, a retirement account or 401k for that matter. And so it fits the same bill where that's something where you're responsible, for taking draws from that and really being a steward of that account to make it last for you. And so when we look at this, a couple sort of key bullets for each, for Social Security, on the pros, there's a cost of living adjustment there. I noted there's a partial survivor. So what that looks like is if you or your spouse pass away, the surviving spouse does not get to keep both Social Security benefits. However, they get to keep the higher of the two. And so Social Security planning is critical and something that we really dial in with our clients to make sure you and your spouse as a team, we are determining what the best strategy is, because that's a pretty permanent decision and a key component in anybody's retirement income. And going back on the cost of living adjustment, that is one positive of Social Security. We saw a nearly 9% bump in Social Security benefits this year. And so that does have the ability to flow and really adapt to different inflation that we might experience. Okay, the pension, so the second box here, again, Boeing has a pension program. You could elect to do that, rather your lump sum. In many cases, we have clients that might have two Boeing pensions, one through, they call it a BCERP, but that might be a SPIA pension. And then, in some cases, you might also have a PVP pension as well. And so you are able to make different decisions with the two of those, so that's something we really suggest looking at. And we like to kind of run the numbers of our clients and see what decision makes sense for most. And while the positive of a pension is, hey, it's nice getting that mailbox money every month, coming in, you don't have to worry about, what the market's doing. On the flip side, there's no cost of living adjustment, right? So any paycheck you get in year one of retirement, it's going to be the same amount in year 20 and 30. And a hamburger is going to cost a lot more in 30 years than it does today, right? But your pension won't adapt for that. Different survivor options for the pension too. So again, that's kind of an individual decision we have to dive in on based on your own personal picture. But that's a key as well to make sure we have longevity, not just for you, but your spouse as well. And then lastly, on the investment folks, or on the investment section, in many cases, half your retirement income or more might be coming from draws from your retirement accounts, your 401k, your IRA, your lump sum. And so it is critical to have a personalized investment plan with that is matched to your own situation and able to weather periods of turbulence like we're experiencing now. If your investments are not allocated properly and do not match your picture, that's where things like sequence of return risk can really deteriorate your portfolio and put you off course. And so, again, it's really critical to match your investments and have a game plan on how to do that, so we're not getting off track anywhere. We've seen in quite a few cases where folks have had a large proportion of their 401k in their company stock, their Boeing stock, for example. And as we saw, right, between the highs and, before COVID and before the MAX issues till today, Boeing stock's still less than half of what it was, a few years ago. And so again, imagine retiring in 2019, you're feeling good, your Boeing stock has been ripping and roaring. And then, by being allocated the wrong way, half your portfolio has been diminished, plus the draws that you've been taking. And so again, that's a perfect example where having too much in any investment or too much concentration in any segment can really, put you at peril. And so for the clients that we work with, it is a critical component of building portfolios is bucketing your spending into time horizons. What do we need in the short to midterm, and how are we going to invest in relation to that? What's more longer term money? What investments are we going to use there? And then how do we take income? How do we rebalance? How do we refill those different buckets? And so this is something that we specialize in. And, with the clients that we work with, really come up with an intentional game plan on, to ensure that we're able to make it to the finish line, no matter what's thrown at you during retirement. Yeah, so here's a neat visual from our retirement planning tool that we leverage that illustrates this. And so you can see the income is variable, the income sources. And on top of that, it is going to change over time, right? So in this chart, you could see on that certain point, Social Security slipped on, and then that will increase with cost of living adjustment. Once you're 73 now, they keep kind of changing the number on that. You have to take a certain amount from your retirement accounts. That's called an RMD, a required minimum distribution. Likewise, there's certain accounts you might want to tap early in retirement. And so, don't get me wrong, I love Excel as much as the next person, but it's great having tools like this where we could really get under the hood and dive in and come with an income plan for you that is sustainable and also minimizes your taxes, right? But this is a good visual that just shows how your income sources will also vary over time too, depending on your picture. All right, so I got a section on this because this is really critical. But we see it all the time is, missing the nuances of, hey, gross versus net of tax take home is a big deal. And, while we see our 401k balances as a gross number, your income, is negotiated and your salaries are announced, as a gross number. The net take home is really what matters. And this is especially, instrumental during retirement. And so, something I bring up a lot is this example, kind of a visual of a retirement tax headlock, right? And, what that is it's saying, look, in your retirement, even though you're not working anymore, not earning a salary, between pension payments, Social Security benefits, required minimum distributions from your retirement accounts, the current expectation that tax rates are set to go up in a few years in 2026. We see it time and time again where folks are in a higher tax bracket when they're retired than when they're working. And so again, as you can see on the slide, $1 million on your 401k statement might only be $800,000 in actual spending ability. Or worse, could be $750,000 or $700,000, depending if you move to a different state in retirement, for example, that has a state income tax. And so what we really like to do with our clients is run an annual tax projection, overlay that with a longer term tax plan. And so we got to figure out how to squeeze, the most out of your, assets, out of your wealth, to net the most to your bank account to support your retirement. Yeah, you saw me get kind of excited with the retirement tax headlock because this is a big deal, and everybody at Boeing needs to be thinking about this, really all retirees in general. And so, here's kind of some key strategies to really think about how to, take home the most net of tax, right? Focus on the net. First of which is tax bracket management. And what that is looking at what tax bracket you land in now, where you expect to be in the future, and then how do we maximize the favorable tax brackets today or in certain years to give you more relief down the road, right? So you're not in a higher, unfavorable tax bracket down the road. And so that's a big one, especially like I noted, we have very favorable tax rates right now that are set to sunset and revert back to where they were in 2026. In addition to that, looking at Roth conversions is a biggie. That's a way to fill up favorable tax brackets. Move money from a pre-tax account to a tax-protected account at a more reasonable rate. For example, in the early years of retirement, we call them the gap years. That might be a year when you retire, you no longer have a salary coming in. If you do the lump sum, you don't have a pension. You haven't started Social Security yet, potentially. This is sort of a blank canvas where day one, your income for tax purposes starts at zero. These could be, terrific years where in addition to taking a retirement income draw, we could possibly do a Roth conversion at a very favorable tax rate to start moving some money from that, gross of tax bucket to the Roth account, which is protected from taxes. In addition, investment location's a big one. Everything in your IRA, everything in your pre-tax 401k, all the growth on that is going to be subject to ordinary income tax too when it comes out, right? It's not just, the current balance. Likewise, a Roth account, all the growth is tax-free. A traditional brokerage non-retirement account, all the growth is only taxable when you sell something and realize the gains, and it's generally at a lower tax rate, a capital gains rate, even possibly a 0% rate. And so what investments to hold where goes a long way in terms of saving, massive taxes. And then another one, strategies like tax loss harvesting, really opportune given this volatile market that we're in, where in a non-retirement investment account, when the market's temporarily down, let's capture and realize some losses. You could use those against other gains, and then we could reinvest the amount in a similar investment or rebalance into a maybe better investment while getting the tax savings today that you can continue to use in the future. And so again, the good news is there's proactively ways to wiggle out of that tax headlock, retirement tax headlock that I noted. And honestly, between lifetime tax savings, Medicare premium surcharges, for a lot of our clients, I'd say most of our clients we work with and implement, these tax saving strategies will save in the magnitude of, what could be hundreds of thousands of taxes over your lifetime. And so that is real numbers, right? That's going to end up in your bank account and net. And so this is a massive savings that, we have control over and we need to be maximizing. And, by the way, this is just ordinary income tax that I was referencing. In Washington, we have a state estate tax. We worked with a client just recently where by doing, timely estate planning strategies, we were able to save them, north of $800,000 in taxes for their family. And so again, there's a lot of different proactive strategies, both on a year by year, but a long-term basis for us to really maximize to get the most out of your nest egg and, maximize your investment return. And so, I'd really suggest, we'll hit on this a little bit later too, take a meeting with our office. Now is a great opportunity to reshape the tax character of your accounts, especially in those last few years of retirement, and set yourself up for much more tax flexibility. So this is what we do with folks, and we're happy to just give you a second opinion, no commitment whatsoever, where we could look at different strategies, to really get the most out of your wealth, save on taxes, and allow you to maybe retire earlier, right? Or with a lesser retirement number, given all these efficiencies we could pull out. Yep. So as we kind of move on to the next slide, as I noted, the few years of the head of retirement are really important to getting your financial picture retirement ready today. So these aren't things you have to wait till retirement for to implement. It's actually better to do so beforehand. Now that we've kind of gone over what's your dream retirement, working backwards. Okay, once I move into retirement, what are my retirement streams? Now we're able to really, kind of get to, the end goal and say, okay, what is my retirement number that I need, to retire comfortably? And so, when looking at that, it really is wrapped around what's a safe withdrawal rate. And what that means is, okay, so I figured out what I need to spend in retirement. I know what I'm going to get from, Social Security and pension and whatnot. So I figure out how much I need to take from my portfolio. How much do I need? What's a safe amount I can take, to, drive that, withdrawal each year? And so this is a really tricky one, right? The question is 3% safe withdrawal rate? Is it 4%? Is it 5%? Because, depending on what number that is determined, that has a massive range on what your retirement number is. And here's an example. So Morningstar is a great publication. They provide a lot of retirement research that we love to leverage. And every year they come out with, hey, here's the safe withdrawal rate for this year. And so kind of interesting, last year they said the safe withdrawal rate is 3.1%, which by the way is a pretty low number. That does not give you a lot of, leg room there. More so, this year they came out and said, okay, now the safe withdrawal rate is 3.8%. And, that has a massive difference, 3.1 versus 3.8% in terms of how much you need to retire. That would be like saying, I need 1.3 million to retire or 1.6 million. That could be several years of work, right, before you hit that level. And so, again, it's really hard to have an approach where it's changing year to year. What happens if you just retire and the safe withdrawal rate's 3.8%, and then next year they tell you it's 3%? You can't go back to work, right? That's not how we want to do it. And so, we like to come up with a withdrawal plan that is more, all weather, let's call it, and able to be dynamic no matter what environment that we're in. And so the way that we approach retirement withdrawals is twofold. First of which is, in addition to just saying, hey, here's a percent withdrawal you can take, everybody's situation is different. People have differences in terms of what their spending needs are. What their social security plan is, if they have to help others, if they have long-term care insurance, if they don't have long-term care insurance. And so really, our goal is, how do we safely get the most out of your retirement? And so, we have again, a retirement planning tool that we leverage for clients, where we're able to run a stress test analysis called a Monte Carlo. And this ensures that your retirement plan works in all different types of environments. So whether we're on the brink of the 2008 type super recession, if we're going through a really strong period of performance, if we're going through inflation, if we're going through deflation, we want to make sure we have an all-weather approach, and we could really stress test it by using these tools. Likewise, we combine this where, it's sort of a guardrail withdrawal rate. And what that means is, for some clients that we work with, some folks, their goal is to squeeze as much as they can out of their nest egg. And so what that means is, for somebody who says, look, I don't have any kids, it's not important for me to leave money behind when I'm gone, but I don't want financial stress. How do I squeeze the most juice out of the orange, right, out of my retirement nest egg, without putting myself at risk? Other people might say it's important for me to leave money to my heirs, right? Or someone might have a special needs child where it's really critical to leave some money in that, special needs trust, for example. And so it's really situational. What's great about the guardrail approach we use is it allows us to be more dynamic, where we could take out the maximum in our view, which in many cases could permit a 5% draw, rather than a 3.1 or 3.8%. However, we need to make sure we stay in those guardrails. And so depending on what the market does, where inflation is, there might be years where you're able to get a raise. There might be years where you don't get an inflation raise, right? But it allows us to safely take the most amount out. And so by kind of combining this guardrails approach with, doing the stress tests and, kind of the retirement, scenario analysis, that allows us, working with our clients to make sure that we can match their goals, most importantly, in a sustainable, safe way. Because again, the last thing you want to do is be 10 years into retirement and dusting off the old resume, right? We want to make sure this is a permanent retirement when you decide to take that step. And so, before I get a little further in that retirement number and how to calculate it, remember, retirement income is not linear. And what I mean by that is a withdrawal strategy can be really variable. So, it's not as easy as saying, okay, you could take out 4% a year, or 3.8 or 4.2. Remember that your expenses and income streams are going to change and be variable through retirement. A perfect example of this is for a lot of the clients that we work with, at least one spouse, we really suggest in many cases them waiting to delay their Social Security, if not waiting till it maximizes at age 70, for example. And what that means is we're going to have a big income stream flipping on down the road in a number of years, which isn't there when you first retire. And so in this case, we are bridging to Social Security. And so commonly, we'll be very comfortable taking out 6.5, in some cases 7% draw in their early years of retirement, knowing that much of that draw is going to be substituted for a larger Social Security payment that kicks in. And so again, that's why it's not, as easy as, hey, here's a withdrawal rate you could take. In some cases, you could absolutely take more. Likewise, like I noted earlier, tax rates are set to change down the road. And so, furthermore, you're going to have required minimum distributions you have to take out from your retirement accounts. Tax laws are going to continue to change. And so these are all a little bit of a moving target that we need to make sure we have, some range, some room to be nimble to deal with, these really seismic changes that we could be facing and will face, in the years ahead. And I'd say the last example of that is, your spending also is going to evolve over time. In the early years of retirement, you might be more attuned to wanting to do travel and activities in early years, while later years of retirement, it may be less activities, but more medical expenses. And so again, as long as we're really able to come out with a strong, spending cash flow plan, it could absolutely be okay to take out, a larger draw in early years, knowing that some of those activities are going to roll off over time. I think one example of this is, we commonly, we'll have clients that say, hey, I want to purchase a travel trailer when I retire. We want to see the country. I don't have to be at work at Monday morning at, 6:30 a.m., 7 a.m. to kind of kick things off. And so, that might be something that they're going to look to do, a purchase and spending attached to that, with a plan that may only have 10 years, run on it. And then that extra spending or travel might go away. Likewise, a lot of medical expenses crop up in later years, long-term care expenses. And so again, for each person, you have your own individual situation, but we want to make sure we're coming up with a custom spending plan to you to match your investments to. And then inflation's a biggie too. As I noted earlier, the Boeing pension does not have a COLA. It does not have a cost of living adjustment. And so you might need to lean more heavily on your investment portfolio in future years as your pension doesn't pick up the slack over time. Okay, I guess just sort of segueing into that, a few retirement icebergs. So these are things that can sneak up on you in retirement, to really be mindful of before you take the plunge and when you're deciding what I need to retire. Long-term care is a biggie. We commonly see, long-term care expenses could be $10,000 a month or more, and that has tended to go up at a much quicker rate than inflation over time. And so, for many, while you might say, hey, I'm going to use my home equity, for my future long-term care expenses if we cross that bridge, about 2 out of 3 people require long-term care expenses down the road. Some challenge might be, hey, if your spouse is a few years younger for you, or it might be a situation where, one of you has long-term care needs, the other's in good health and doesn't want to sell the house, right? And so these are things it's good for us to come up with a map before you take the plunge into retirement, just so we're ready, if some of these surprises come up, how we're going to navigate that. And like I noted on the prior page, inflation's another one, right? If we continue to have 6% inflation, 7% rather than 2%, that has a huge impact on your, total expenses over your lifetime in retirement. And so we believe, especially during times like this, it is critical to have inflation hedges in your retirement investment portfolio where we're able to, adapt and adjust and pivot if we do see sustained inflation. And so, lastly, your retirement number is contingent on you executing the plan laid out. And so that includes being invested the right way, having a plan, sticking to your plan. And so, for example, this last year is a great, example of that. The average retirement portfolio was down about 15% last year. If you look at all these target date retirement funds, I think in many cases, more than 15%. And so if someone's about to retire, if somebody retired at the start of 2022, let's just say they're drawing, a ballpark of 5% draw on their accounts. Likewise, let's say their portfolio was down 15%, if it was just in one of those target date retirement funds. 15% market down plus 5% withdrawal, doesn't take a lot of math to say, hey, that's 20% less at the end of year one than you were at the start of retirement. 1.5 million, would be 1.2 million 1 year in. And so again, the biggest mistake we commonly see is clients not investing their portfolios to their personal needs, not having a plan to weather periods like this, and then getting off course and making emotional decisions during tough times, right? Like we're going through. And so again, this stuff's emotional. Likewise, you're going through retirement for the first time and ideally only time. And so this is something you don't have experience in. And again, this is why we just really strongly suggest working with a professional financial planner, like what our office does, where this is, what they specialize in, what we specialize in. And we're doing this every day for clients, right? So it's not like you're having to go this alone with the first and only time you're retiring. And, because there's too much at stake, right, to make mistakes and learn along the way. Again, we don't want to be dusting off our resume, 5 years into retirement. And so when we sum everything up that we covered, coming up with your retirement number, in those early years of retirement, it typically comes out between 3.5% and a 5% withdrawal rate. And so what that means is if you determine that you need to take out $5,000 a month in retirement from your retirement portfolio, $60,000 a year, which your pension, for example, isn't covering, or other income sources, that would equate to having a nest egg of 1.2 to 1.7 million. And so again, as I went through, I know it's a really case by case, personalized situation. I know this is a pretty wide range as well, but I hope this kind of helped give you some context in terms of these are the steps you need to take to plan a retirement. This is how you could kind of back into what do I need in my, what's my retirement number? What do I need to sustain that? And then some of the important aspects, retirement icebergs, decisions to make along the way. And again, I couldn't, can't say it enough, work with a certified financial planner to help you do this exercise. I think it's helpful having, this sort of framework to kind of, think through it. But as I've shown, there's a lot of tools and technologies out there that can result in a much better success rate, not to mention working with someone where they do this day in, day out. And so, those last few years of retirement are a perfect time to link up, with our office or another certified financial planner, to kind of put together a roadmap and sort through, hey, what do I need to be doing these last few years of work to make sure I know when I can retire, I'm doing everything ahead of that time, and I'm ready to take the plunge. So yeah, take us up on a free second opinion on your investments and retirement plan. That's what we're here for. We're offering a 1-hour complimentary financial checkup where we could dive in, kind of see what your retirement number is and figure out some of those personalized, situations and aspects that we need to navigate through. You can contact our office, directly, give us a phone call, 425-646-6327. You could also email Sean as an advisor on our team, Sean@stablerwm.com to do that. Likewise, a really good way to sort of sign up for that is you could go right to our website and set up a time to contact us as well. So even right now, if you want to kind of jump in your browser and go to www.planyourboeingretirement.com, that takes you to our Boeing page. In addition to providing, much of this content that we're providing, there's a nice little button on there you could click to kind of, shoot over your information and say, hey, I want to take you guys up on that 1-hour complimentary session. And so, yeah, I'd encourage while we're doing it, feel free to jump in onto the website right now, www.planyourboeingretirement.com. Click Let's Get Started. Shoot us a note that way, and then we'll get right back to you and set up a session where we could, help you map out your own retirement picture. And so, yeah, thank you again for joining today's webinar. As noted, we're going to continue to do our webinar series and look to provide these on a monthly basis going forward to provide you with good, important, needle moving information specific to Boeing professionals. Please pass on our information to your colleagues as well. Again, the more people we can help, the better. So we'd love to get more reach with what we're doing. And if there's any key topics, you're really interested in and would like us to shine a light on, please reach out. Again, you can go to our website and contact us, or, email us at sean@stablerwm.com. But we'd love to hear from you in terms of what topics would be helpful for us to focus in going in down the road. So again, thank you so much for your time. I look forward to speaking with many of you, and have a great rest of your day. Thanks and take care. Bye.